Good evening, ladies and gentlemen. This is Barry Norman on behalf of CMS Capital Markets Trader, and welcome to our class on moving average convergence and divergence, or called MACD. Now, tonight's class is sponsored by CMS Trader, Capital Markets Trader. You can find them by going to www.cmstrader.com, and you can set up a demo account while we're in class and use their charts to follow along as we learn how to use MACD. There's no credit card required, no deposit required. You can just set up a demo account. Now, because CMS Trader is a regulated provider, I'm required to give you a risk warning. So let me read that and get it out of the way. Trading Forex, CFDs, and spread bets on margin carries a high level of risk and may not be suitable for all investors. You may lose more than your initial deposit and could be required to deposit additional funds. Please ensure you fully understand the risks and take care to manage your exposure. Now, if you go to www.cmstrader.com and just click on the buy or the sell button, it'll just open up a little screen where you put a username and a password in, and it will open a demo account for you immediately. And like I said, you can use the charts right there and then to follow along and try to put MACD on as we go step by step. Now, as I said, CMS is a regulated provider, which gives you guaranteed security and means your funds are segregated. They give you a broad range of education materials, classes, webinars, seminars, all types of ebooks and videos to make sure that you understand what you're doing and understand the risk you are taking. They also give you free daily signals. They give you free daily market updates and technical analysis and super fast execution speeds. They offer a wide range of instruments from CFDs for stocks, commodities, and index, and Forex trading. And you can use their Watch, Copy, Profit social media outlet to follow along and see what the best traders on the platform are doing and copy their trades if you like. You can also learn how to become an independent trader with CMS Trader. Use their video tutorials for both the beginner to the professional, get one-on-one sessions with a financial expert, and get a full library of ebooks. So let's get started talking about MACD, moving average convergence and divergence. Now, tonight's class is being recorded, and you can access a recorded version of tonight's class in about 24 hours by going to investing.com, where you signed up for the class. Go under the webinar tab or the education tab and look for webinars on demand, and you'll be able to find this class in about 24 hours. Now, MACD was developed by a very well-known technician named Gerald Appel. He's developed a lot of indicators in the marketplace. He specializes in momentum indicators. But now, when he developed MACD was a lot of years ago. And the only actual kind of market trading we had those days was the stock markets, you had commodities, but they were all traded by professional traders. There was no online trading. And he was developing this for stock traders or stock brokers, so to speak. And MACD would spot changes in strength, direction, momentum, and duration of a trend in a stock's price. Now, as online trading grew in popularity, and as the Forex market exploded and then the CFD market exploded, Mr. Appel has redeveloped MACD and given us new interpretations on how to use MACD for Forex and CFD trading. And this has become, or MACD is one of the leading Forex indicators. Can you hold on a second? I think every class we get somebody who sees that they're muted. They don't understand. Mute means they can't talk, not that they can't hear. And They keep writing me, why can't I hear? Why can't I hear? Unmute me. And they don't understand. It's just a problem on their own size computer. Mute means simply we're not having a two-way conversation. You can't speak to me while I'm speaking to hundreds of you out there. And it means your microphones are turned off, but your headsets aren't turned off. So, and unfortunately, I can't answer that person without stopping and typing an answer, but it's done. And hopefully they'll get themselves straightened out. So let's go on with class. Now, MACD is one of the most popular and broadly used indicators for Forex trading. The letters MACD is the abbreviation of moving average convergence and divergence. The basic function of the MACD Forex indicator is to discover new trends and help identify the end of current trends. There are various ways to gauge the signals generated by MACD, and many traders use their own unique settings and methods around this indicator. Now, there is lots of stuff in the internet about MACD. Most of it are some type of guru who's trying to build some type of reputation, who's giving you some type of system to tell you to do that, or to buy his app, or to download his thing to get him to follow his system. Okay. I'm not saying their systems work or they don't work. But to me, they're all garbage, because unless you can think in their mind, you don't understand exactly in all the ins and outs. Now, MACD is a great indicator, and it's not a complicated indicator. But you have to start from the beginning. You can't follow somebody's system. You have to learn what all these lines are doing, all these calculations, where they come from. Because when you understand where these calculations or where this indicator comes from, you can then interpret it because you understand what you're looking at. So tonight, we're going to go step by step through the process of building MACD onto your chart, step by step. Now, I have tried my best, and I've given this class many times, but because MACD is involved in a lot of lines, it is a very wordy class, and I'm apologizing for it now, but you need to follow along, because when we're finished tonight, you'll be able to look at MACD on a chart and say, yes, that's generating a good signal because I could see that in comparison to this, and I know why that signal is happening. No, that's a bad signal or a false signal because I understand what I'm looking at. Not that Barry told me when MACD is above 1 to make a trade. So the MACD indicator is typically placed on the bottom of the trading chart in a separate window beneath the price chart. The moving average convergence divergence is a relatively easy tool to use. However, it is crucial to understand it fully before attempting to trade using its signals. Now, we're going to go back and forth from an actual chart to my words, and I'm going to try to make it as interesting for you as I can. So the concept behind the MACD is fairly straightforward. Essentially, it calculates the difference between an instrument's 26-day and 12-day exponential moving average. Now, we all understand what a moving average is. A moving average is simply a number of bars or a number of closes added together and then divided. So if you're looking at a 26, and when we use the word day, we don't mean 26 days unless you're looking at a daily chart. If you're looking at a 1 hour chart, it would be 26 lines on a chart, or 26 candlesticks, or 26 bars. And if you're looking at a 15-minute chart, it's 26 of those 15-minute bars, okay, as well as a 12-day moving average. So what you would do is if you're looking at a 1 hour chart, you would take the last 12 bar charts or candles and take the close of the last 12 segments, add it together, and divide it by 12. You'd also do the same thing for a 26-period moving average. Now, an exponential moving average is a little bit finer of a calculation because it puts a little bit more value on the most current numbers and a little less value on the older numbers. Now, let's start with some common sense. Let's stop thinking about a Forex chart, and let's just start thinking about what the difference is between a 12 period and a 26 period moving average. Now, if I were to look at something that happened over the last 12 days or the last 12 hours, whether it's a movement on a chart or how many cars passed my house or how many dogs barked, I would take the last 12 periods, add it together and divide it by 12. Now, what is more important, something that happened 12 periods ago or something that happened 3 periods ago? Well, what happened 3 periods ago is a little bit more crucial than what happened 12 periods ago. But when I use a 12 period moving average, I'm using the last 12 segments. So if we're using 12 1-hour bars, we're looking at the last 12 hours. When we compare that to a 26 period moving average, I would be using 26 bars or 26 hours. So which one of those two moving averages would be more responsive to the shorter term price movement? Well, that would be the 12 period moving average because it's only using the last 12 hours. And so if the asset went up or down drastically, or not even drastically, up or down in the last 12 hours, it's going to respond faster because the other one's using 26 periods. And so it's adding a lot more periods together and dividing it. So your 26 period moving average is referred to as the slower moving average. And the 12-day moving average is referred to as the faster moving average. So let's go look at this or put this on a chart. So let me pop up a chart here for us. Okay, so now we're looking at it. This is the current Euro US dollar chart. Only reason we're looking at Euro US dollar is because it is the most popular asset in the world. Okay, we're not looking to make trading decisions. I'm not making any recommendations on the Euro US dollar tonight. I just use for class the most popular asset in the world. Now, on the price chart here, you see I'm using a bar chart. You can use a candlestick chart, doesn't make a difference. We've now put on 2 moving averages. You can see that our top EMA is using a 12 period moving average, and that's the red line, and I've just color coded them for you. Okay, that's the red line. That's the 12 period moving average. And the blue line is the 26 period moving average. So if we're using a 1-hour chart, that's the moving average over the last 26 bars or the last 12 bars or the last 12 hours on this chart. Now, you're saying, well, that's just a simple moving average. And basically, that's a simple moving average crossover. Yes, it is. And that's why MACD is moving average convergence and divergence. But what this is that's just the beginning of the MACD. Okay? Because technically, once you put MACD on your chart, you never have these moving averages for MACD on your chart. Okay? I've put them there so you can see where they come from. Now, MACD is a derivative. And it's a derivative is something that's away from its original price or its original offer. MACD is a 4-level derivative because it's 4 steps away from the price. So the first derivative are the moving averages, because all the moving averages softens or takes the noise out of price and gives you a gentle movement of price. So it's an overlap of price at use price. Okay, so that's the first derivative. So we have our fast moving average and our slow moving average. Okay. Now that wasn't too difficult yet, but they're about to go bye-bye. Okay, because this is just the starting point for MACD. So let's go back to my PowerPoint and let's see what the next step is going to be in building our MACD. Now, on the MACD chart, Of the two moving averages that make up the MACD, the 12-day move EMA is obviously the faster one, while the 26-day is slower. In their calculation of their values, both moving averages use the closing price of whatever period is measured. On the MACD chart, a 9-day EMA of the MACD itself is plotted as well, and it acts as a trigger to buy and sell decisions. The MACD generates bullish signals when it moves above its own 9-day EMA, or it sends a sell signal when it moves below. But we're not even over to this trigger point yet. What we are is we now have to come up with what's called the MACD line. That's this blue line right here. This is the difference between the 12-day and the 26-day, or the 12 period and 26 period moving average. And then it is plotted, the difference is plotted on a chart below the price chart. So what we do is we go back to our chart. Now, all of this sounds like it's time consuming, but it isn't, because after tonight, once you understand all these lines, you'll never do the calculations because all of it's dropped on your charts for you. So what we do now is we take and subtract, and we actually do a mathematical step, and we subtract the 12-period moving average from the 26-period moving average. We take the difference and we put a dot on the chart below. Now, the chart underneath starts out with what we call the zero line. We just take any point and we draw a line and we call that zero. And we draw that line going forward. Now, when the 12-period moving average and the 26-period moving average cross each other, like they did right here, or they did right here, or they did right here, what would the difference be? The difference would be zero, because the 12 period and the 26 period moving average, when they cross over, there's the same number. So when you subtract one from the other, you would have zero. So if we're plotting that down below, and actually let's get some of this stuff off the chart down below. I'm just going to take some stuff away so we can actually see how this is done. So we're going to get rid of the histogram because we don't need it now. We don't get rid of the signal line. We're going to make this a dark blue line, make it broader. And we then plot the difference between the blue line and the red line above on the chart below, above and below the zero line. And so all we're doing is we're subtracting one from the other, and we're taking the difference and putting a dot on the chart below. Okay. They don't range that much because, like I said, whenever they cross over, they're always zero. When the 26-day moving average crosses over the 9-day moving average, the difference would be negative. When it crosses above, the difference would be positive. So we can see the the MACD line down below moving, and what is it? It is the difference of the width of these two moving averages. So we can see the red moving average, which is a faster moving average above, as it separates and falls below. I'm sorry, I might have crossed up my lines here. Hold on a second. Okay. When we see the 12-period moving average below the 26-period moving average, we would be taking that 12-period moving average and subtracting the 26-period moving average. So when that 26-period moving average is larger than the 12, we would get a negative number, correct? So when we would take that negative number, it would always be plotted below the zero in whatever that negative territory is. When the 12-day moving average is higher than the 26-day moving average, it becomes a positive number because we're taking this number up here and subtracting that number, and so that number is positive. So what we can see in the blue line down below is our zero line. So we know every time it crosses the yellow, every time it touches this yellow line, it's at zero. That's telling us that the MACD, the 12 period and 26 period have crossed. And if it's moving upward, it's telling you the shorter moving average is bigger than the longer moving average. So that's telling you that the larger price movement is more current. So look at this. When we see price soar up here in the moving trend, we saw the shorter moving average is much higher than the longer moving average. And when we subtract them, it is a very high positive number. As they ease off, it becomes a negative. So we can tell that whole story in price by just looking at how the blue line moved below. And this blue line is referred to as the MACD line. Now what happens is we get rid of the 12 and the 26 period EMAs because we don't need that anymore in our MACD indicator, because we don't want to see it on a chart because that's just a simple moving average. It's a moving average crossover. So you can use for moving average crossovers, whatever. You can use a 10 to 20 day, a 10 to 30 day, whatever, because that's got nothing to do with MACD. Right now, they gave us the calculations to do this blue line. Now, we now moved also to one step farther away to a farther set derivative. So now we have to add on another line. Yes, and there's lots of lines because we have the MACD line now generated and we have it moving up and down, but that doesn't tell us anything on its own. So we have to create what's called the signal line or the trigger line. And this is a little bit weird. It's not complicated. It's a little bit weird. What it is a 9-period moving average of the MACD line itself. So in other words, we take the calculation that we use to come up with this number here on that line, and we take 9 periods back, add them together and divide them and plot them as the signal line. So this is a derivative of a derivative of a derivative. Now, why is that done? So let's talk about why that is done. Hold on a second. Let me just get my markings off of here. Okay, we don't want the histogram yet. Okay. So what we have is the MACD line, which is a 12-period EMA minus the 26-period EMA, and then the MACD signal line, which is a 9-period EMA of the MACD line. We do this because we need something that will give us a crossover Okay, somebody asked me why 9 periods. I couldn't tell you for the life of me. Why it's 12 period and 26 period for the lines above that? Couldn't tell you that for the life of me either. And it is a very good question, but a very poor thing to waste your time on. Okay. The fact is, Gerald Arpel developed this 30 years ago, and he tested it and back tested it, tested it and back tested, tested and back tested, and came up with the correct periods that worked for the signal and that worked correctly. So it's like any other indicator. Anytime you change it from the way the developer developed it, it's no longer MACD or something else. So for instance, if we wanted to change this to a 20 period and a 10 period EMA and then make it a 14 period down below, it is now a Berry indicator. Okay. For the person who says which one is the 12 and which is the 26th day, it doesn't make a difference. Okay, I explained that. You've done the calculations, you put them on, you've subtracted one from the other, and it's given you the MACD line down below. You never ever have to do this because it's done for you automatically. Okay. Now, MACD is a world-known indicator. If you can't follow my explanation, because yes, some of you, English is a second language, which I'm not downplaying for you, or some of you, I talk too fast for some of you. I understand that, but we only have a limited period of time. It's very easy to go to the internet and do a simple search for MACD. There's tons of literature out there. Like I said, don't read all these people's strategies. Go to like Investopedia or Wikipedia and read exactly what I'm telling you, and they'll give it to you in the same steps, but maybe when you read it, it's a little bit easier. Now, for those of you who want to jump way ahead and want to ask what a histogram is and what value it is, let's get there first. We're going step by step and trying to get to where we've got to go. Okay. So, because when you place the MACD line down below, and it's only the difference between the 12 and the 26 period above, it's not telling you anything. You need something for it to relate to. And that's why we develop the MACD signal line. And it is a 9-period moving average of the blue line directly above it, the MACD line. So if the MACD here was 0, because it crossed over, you would take a 0. If the next day the separation was 1, and the next day the separation was 2, and the next day it went to 3, and the next day it went to 4, then it was 2, 2, 2. You just add them together for 9 periods, divide by 9, and that's the number, the dot you put on your chart, and you get it. So because what we're looking for in the MACD indicator is ultimately the crossover between the signal line and the MACD line, because the signal line is exactly that. It is a signal. It generates a signal. It triggers something. So what we're looking for eventually is the crossovers between the MACD line and the signal line. When they cross, whether one crosses the other or the other, they give us buy and sell signals. Okay. And that is why that second line is important, because without that, we have nothing that's generating any type of signal or indicator for us. So in downtrending markets, we talked about the fast moving average will move down faster than the slow moving average. As the fast moving average diverges from the slow moving average, the MACD will illustrate that relationship. And that is the MACD line itself. Then we come to the next part. Okay, the key is part of this indicator, and something we will delve deeper into on the MACD strategy, is using the MACD as a trigger into trades. So we have built this chart below our charts. When the MACD line crosses the signal line, above or below, it gives us different signals. So when MACD crosses below, down and below the signal line, so in our graph, when the blue line goes below the red line, we then are generating a sell signal. The opposite is true. So MACD can be helpful for noticing potential trend changes at the very early stage of its currency pair. Okay. However, if we wait for the zero line crossover, the MACD to cross the zero line, we are essentially trading a moving average crossover, which is inherently lagging the market and may not be optimal point of entry. This is where the signal line comes into play. The signal line is simply a moving average built on the value of the MACD line. By default, this value is commonly set in 9 periods. Building on the relationship of the MACD line itself, traders very often look for entry opportunities when the MACD crosses the signal line. When the MACD crosses above and over the signal line, it is looked at as a buy signal. When the MACD crosses below the signal line, it is often looked at as a sell signal. So let's go back to our live chart. And we're going to go put the rest of the lines on our chart. I'm going to turn them back on because I turned them off before. And so we're using, I just want to go back and see what color they're using, make sure we use the same color we're using on the other charts. Okay. So the MACD line is red on this chart. So let's go put it in red on our Euro US dollar chart. Okay, so I'm getting rid of this entire MACD for you now. So it's gone because you all keep asking me all the same questions here. So I'm going to show you how this is done. MACD is gone. And it doesn't matter whose chart you're using. Somewhere along the line on that chart, you're going to get a choice to add indicators or technical analysis to your chart. And because MACD is such a popular indicator, it is on every chart. So we're going to go up here and click on indicators, and we're going to just simply scroll down till we find MACD. And we're going to click on MACD. And look at that. It's already on our charts. Now, because we want, we can colorize it and customize it. So what we want is we want the histogram line to be red. We would like the MACD line to, we want the histogram to be gold. And we want the signal line to be red. That's only for this class. Okay. You can make them any color you want. And the best part of doing this on your own is you won't make them that you know exactly what is the signal line and what is the MACD line because you've put them on in the colors that you have in your head. Doesn't matter what colors you're using, just so that you understand them. So every time we get the crossover here, 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 we're getting either buy or sell signals. Correct? So now we are at a derivative of a derivative of a derivative. And the MACD is giving us buying or selling signals, and it's generating lots of them. Now, the fact is, we can't just, the MACD signals are usually never wrong. But it can give you a lot of false signals because none of these signals are telling you how far that price should go. So what they're saying is you have a buy opportunity, but it's not saying it's even going to go higher than the spread because MACD doesn't tell you on here what to do. It tells you buy or sell, but you then have to determine whether that's a buy opportunity or a high probability, high profit opportunity. Because if you just did buy and sell every time MACD did, you probably end up losing your shirt. Because by the time you were to enter the market, by the time you cover the spread, and by the time you would possibly exit the market, that little blip wouldn't give you enough points to come out positive. So what the MACD line is telling you, or what the MACD crossover is telling you, is it's generating buy and sell signals, but it can generate lots of false signals. So it is the beginnings of what you would have to use with other indicators to make a determination as to whether it's worth buying or selling. Because it's not telling you, like I said, it doesn't tell you at what price to exit the market, and it doesn't tell you how long that up movement or that buy movement is going to stay into effect. Now, it happens to be like here, we got to sell. By the time you got this and entered the market, that isn't many points. Here you got a buy signal, and that was a pretty good signal, and you could have traded it all the way out to here. Okay, here you got a crossover, and you got a sell signal. Here it was a pretty steep fall, but at what point could you, how fast could you have actually entered the market? What's your spread? You know, especially if you're looking at something like Bitcoin that's got a $100 spread today or a $150 spread, that's a lot to cover. MACD doesn't tell you what to cover yet. But we're not finished with MACD. This is not the end of it here, because we haven't yet to conclude MACD. Now, depending on how much you use it and how good you are, you can completely get rid of the signal line and the crossover line. You ask me why. Because the last step of the MACD is it generates what's called a histogram. A histogram is a bar chart. And what is it? It is a bar chart showing you the difference between the MACD line and the signal line. So we know that every time the MACD line and the signal line cross each other, it's always at that same zero line that we started with a while back. So every time that the price is at that zero line, we know we got a crossover. If the price moves below the zero line, we got a sell signal. If it moves above the zero line, we got a buy signal. Now we can also see how big that movement is, which is helping us determine how big that price move should be. But we want to get in as close to that buy signal or sell signal, but we can watch the growth of that histogram and decide where to enter and exit the markets, because it is almost a visual representation of how price is moving or how the trend is reacting in the current prices. And it keeps you in the front. But you can't just, but that's how you use the histogram, but you still need to keep the signal line on your charts, because it's going to give us more information in a minute, because MACD gives us convergence and divergence as well as overbought and oversold indicators on top of buy and sell signals. So let's go back to my PowerPoint. But right now, you've now put the complete MACD on your chart and understand where each one of these lines come from and what they mean and how they're derived. You never ever have to go through this process again. Now you simply click on indicators and put it there. You color code your MACD line, your signal line, color code your histogram, and once you've set them up, you never have to change them because they'll just go from chart to chart to chart. And you've got that valuable, incredibly great indicator on there. So now let's talk about, or let's learn how to use it in your trading. So in an effort to more closely follow the relationship between the MACD and the signal lines, traders can follow the histogram, which is simply a bar chart plotted around the zero line to indicate the relationship between the MACD and the signal line. Okay. Now, MACD tells us three different stories. The MACD proves most effective in wide swinging trading markets, but you can use it in any time frame, short term or long term. There are three popular ways to use the moving average, convergence, and divergence. We use it for crossovers, we use it for overbought and oversold conditions, and we use it for divergences. So the first are the crossovers, which we just talked about. When the MACD line crosses the signal line, or the signal line crosses the MACD line, it gives us buy or sell signals. The basic MACD trading rule is to sell when the MACD line falls below its signal line. That means that the short-term price is lower than the longer-term price. It's giving us a sell signal. Similarly, a buy signal occurs when the MACD moving average convergence rises above its signal line. It is also popular to buy and sell when MACD goes above or below 0 on the histogram. Because when we go above or below 0, guess what? We've got the crossover. So as you can see on this chart, we got this crossover, which was a sell signal, and the price fell pretty steadily. We got, again, now we got a crossover, the opposite of which is a buy signal. That buy signal was a beautiful long-term buy signal. But in the middle of that, we also got a sell signal. Now, if you would have sold into that market, you would have not lost your shirt, but you wouldn't have made any money because the price did dip down, but not enough to cover anything. Then as we look farther, we get another crossover, which gives us a buy signal, which would have amounted to something, but then right on top of it gives us another sell signal. Then it gives us a buy signal because MACD isn't taking into consideration how big the move will be. So remember that. It's only an alert. It's giving you a signal to get ready to buy or sell, but you have to use other technical analysis to make a determination whether it covers your money management, your risk management, whether it's work trading, how big your trade you're going to be, and those kind of things. But this is simply the signal being generated, or the transaction signal being generated. Now, the other part that MACD does, it tells us if the markets are overbought or oversold. Okay, and that is important. A lot of us use RSI or stochastics for overbought and oversold conditions. But here you've got one indicator that gives you 3 valuable pieces of information. So the MACD is also used with overbought and oversold condition. When the shorter moving average pulls away dramatically from the longer moving average, examples, MACD rises, it is likely that that symbol price is overextending and will soon return to normal realistic prices. So as we can see in this chart here, because we have 2 lines that we're plotting, if you can draw a line and see one is diverging much farther from the other, that's telling you that the market is overbought or oversold. And again, overbought markets can continue to be overbought for a while, but they're eventually going to fall. Oversold markets can remain oversold and will eventually turn up. But knowing that the market has become overbought or oversold might tell you it's time to leave the markets if you're in the market, or it might tell you to prepare to enter the market when the trend is fully reversed. The most valuable part of MACD falls in its what we call divergence. It's an indicator that at the end of the current, it indicates that at the end of the current trend may be near when the MACD diverges from its symbol. So when we take and see price falling, like we saw here, and we would be able to draw a downtrend line underneath the falling, and we see price steadily falling, making lower lows, while the MACD line, which is the black line here, is making higher lows. So the MACD line is actually moving upward while the price chart is moving downward. See how we have the red line, the downtrend line here, but the gap between the MACD line, not the signal line, but the MACD line itself, the black line, is moving. We have bullish divergence. So the MACD line is moving higher, the price is moving down lower on the chart. We've got a divergence. That tells us that that downtrend is about to end and we can expect a breakout to the upside. The reverse is true in the opposite. Okay. A bearish divergence occurs when the MACD line is making new lows while price fails to reach new lows. Both of these divergences are most significant when they occur at relatively overbought or oversold levels. So like I said earlier, you're not going to learn everything about MACD. We've gone over most of it, but you're not going to learn to master this in just one night's class. But this MACD is not very difficult, and there's lots of good literature in the internet. Okay. I don't know about all these short videos. I hate these 1 or 2 minute videos because they just give you cursory information. But if you do a simple search of the internet for MACD and use MACD Forex and don't read anybody else's strategy, learn and read about how to use MACD. Okay. And you'll find all of this. A bearish divergence forms when a security records higher highs and the MACD line forms lower highs. The higher high in the security is normal for an uptrend, but the lower high in the MACD line shows less upside momentum. So we're getting divergence. So when we see this opposite movement between price and the MACD line, we are getting some type of an indicator. So remember, MACD is a fourth period derivative. The first derivative is the 12-day EMA and the 26-day EMA, which we plotted originally on the price chart. Then the second derivative is the MACD, which is the 12-period EMA less the 26. Remember, we took those two numbers that we took off the chart, got rid of that on the chart, subtracted, and made the MACD line below. The third derivative is the MACD signal line, which is the 9-day EMA of the MACD line, which is our trigger line or our signal line. And then the fourth derivative is the MACD histogram, which is the MACD less its signal line. Now, this histogram actually tells you the whole story. And eventually you might get ready to start learning, or when you've used MACD long enough, to be able to look at that histogram and tell the whole picture. So the base for the indicator is the security's price. It takes 4 steps to get the actual price to the MACD histogram. While not necessarily a bad thing, chartists should keep in mind when analyzing the MACD histogram. It is an indicator of an indicator. Therefore, it is designed to anticipate signals in the MACD, which in turn is designed to identify changes in the price momentum of the underlying asset. As with MACD, the MACD histogram is also designed to identify convergence, divergence, and crossovers. The MACD histogram, however, is measuring the distance between the MACD and the signal line. The histogram is positive when the MACD is above its signal line, and the positive value increases for its signal line. Positive values decrease as MACD is for its signal line. Now, somebody just asked me, and this is the last question I feel where I actually finished our class. Is the MACD for Forex, and is the same idea for options trading? Like I said in the very, very beginning, this was originally developed by Gerald Arpel for the stock market. It's now been adjusted and tested and works in all markets. Okay, and that's why we use the 12, the 26, and the 9, because these have been tested in all markets. You can use MACD in all of these markets. Okay, and it works well if you use Mr. Arpel's interpretations and Mr. Arpel's times. Okay. Now, again, how you apply it, the MACD, all the fundamentals we talked about, but you might want to say, because the options market is much different than the CFD or the Forex market. Okay, and spreads might be different, or if you're paying commission, because see, in the stock market, you're paying commission. There is no spreads. So as you get a buy signal, you're not calculating it. You're applying it to your trading differently. It's still giving you the same signal. But guys, on that note, I'm going to say goodnight to you. And it's not a difficult indicator to work with. So go online. Like I said, go to Investopedia, go to Wikipedia. And for the gentleman who asked about the MT4 platform, go and look up MT4 and MACD on MT4, and it will explain it to you, because all of MACD uses the MACD line and the signal line. So thank you very much. Have a great night, and we'll talk to you again real soon. Bye now.